I'm Sarah Lowther, and a very warm welcome to this Netwealth Master Investor webinar, tantalizingly entitled Charting the Course Navigating 2024, a Financial Outlook. So we will be with you for the next hour, where you'll find out how to navigate the economic landscape with confidence and maximize your investment potential over the coming 12 months. So just to explain the format and how you, the audience, can participate, we've got two speakers, there's Q&A, and if you want your questions answered, then do type them into the chat box function. I will be talking to Chief Investment Officer Iain Barnes, who with about 10 minutes to go has stepped in for Jerry Lyons, who is very well, but his technology isn't. He's been let down by a power cut. So Iain's going to talk about the bigger picture, and then we'll be hearing from Tom Kimche, who is Netwealth Senior Client Advisor, who will share financial planning concepts and investment ideas and offer you valuable insights on how you can proactively plan ahead. And of course, do keep those questions coming. Right, so first up, Chief Investment Officer Iain Barnes. And Iain, as we approach the end of 2023, just where are we in the global economic cycle?
Well, I guess the first thing to mention is to say that it's obviously something that's pretty key to how we think about looking after client portfolios, building that big picture overview of how to allocate between different asset classes, and then implement them as efficiently as possible for client portfolios. So where we are now, at the end of what has been a very interesting year in terms of the overall economic picture, is that markets are starting to wonder how far through we are in this journey towards tighter monetary policy, and what are the implications for economic growth in the years to come. Jerry often mentions that, you know, when you're thinking about the global economic picture, a global growth profile of around 4% feels like boom time. A global growth picture of around 3% implies that there's a few areas that are teetering on recession. And I think it's more towards that latter picture at the moment, where we see a very challenging outlook in some ways for the UK and much of Western Europe. And that's where we're pitching at the moment.
Okay, so you say challenging. I'm just wondering, what is the likelihood that the UK is going to encounter recession in 2024?
Well, I think you've got to say there's a reasonable chance. Of course, when we think about this year already, the UK is one of those countries that's been teetering on negative growth at times. Now, there are different sort of flavors, if you like, of recessionary environments. Sometimes people start talking about a technical recession, where you're just not seeing positive periods of economic growth. But then there's obviously more sort of meaningful, painful versions of a recession where it's felt much more broadly. Where we're sitting at the moment is that the UK, is not entirely clear if it's going to be either of those two, or if we might actually be able to generate some growth. When we've been talking about that on the team, we think there are three areas that suggest that you need to be aware that a recession is a possibility. The first is there are weak indicators that are forward-looking, called the Purchasing Managers Indices, and they give a sense of how confident people embedded within the real economy are about their company's future prospects. They've been weak in the UK, much like a lot of other developed nations. Secondly, monetary growth and bank lending are both in negative territory. So monetarist economists would argue that everything flows from what is happening with money, and for certain, after a period of strong monetary growth, we're now seeing the kickback from that, and that's rolling over quite significantly. Perhaps most importantly, however, is just that the UK, like many other economies, has had to deal with the impact of monetary policy tightening over the past 18 months. And all policymakers know that the impact of this policy tightening has a sort of long and varied lag in time. So the policy tightening has taken place, but the impact of that tightening has not yet fed through. So those are three things we need to watch out for. On the positive side, the economy has remained pretty resilient. A lot of people thought that a recession was already a done deal in 2023. It hasn't really come to pass. We've just been sort of very, very low levels of growth. Secondly, the employment picture is also pretty strong. People are holding on to jobs, and of course that gives a more solid base. Thirdly, possibly most importantly, is that you're starting to see the inflationary impulse that was the cause of all of this damage starting to recede. So as inflation decelerates, first at the headline level, impacted by falling energy costs, etc., but then also in core prices, they're both starting to decelerate. So people's real incomes are going to grow, and that's going to provide a real support. And finally, the opportunity from all the tightening that's taken place is that now there's a bit more room for policy stimulus, both in terms of monetary policy, but also on the fiscal side potentially as well. The government might be able to help out.
Okay, we'll come to the government later on because there might be change in administration next year. So where are interest rates headed here? You've told me that the monetary policy and their decision making tends to have a lagging effect, and the indicators are that inflation will recede, but interest rates 15-year high, is that it? Is the Monetary Policy Committee done with raising interest rates?
Well, we think that it's a really interesting dynamic at the moment where market participants are sort of testing how good central bankers are for their word. So they insist that they're still on still have a bias to tighten. Markets are saying, don't believe you, we think you're done with this hiking cycle, and now it's just a question of how quickly that policy recedes. So the first interest rate cuts are expected to be in the first half of next year, and in the UK I think there's 2 to 3 interest rate changes priced before the end of next year. We think the direction of travel is probably right. We're not sure just at the moment if we're going to see that full effect come through, but if it's even more emphatic in the US now, where there's 5 interest rate cuts priced in the US market. If the Federal Reserve in the US start to move interest rates that aggressively, it seems to me it's going to be quite hard for the UK against a slowing backdrop to be able to sustain rates where they are as well.
So let's talk about monetary policy committees here and in the US. I'm just wondering whether the power remains with the MPC and the US Federal Reserve, or are they toothless entities, unable to make much difference with their monetary policies? Will it still be much talk and very little action when it comes to sort of taming inflation?
Well, I think here you've got to think about what's the cause and what's the effect of policy, and whether or not policy changes are just coincident. You can make a decent case that policymakers were generally pretty slow to react. They didn't recognize the damage that sort of super cheap money was doing in terms of the structure of markets, but also the way that economies were behaving. Now, Jerry likes to mention that amazingly, all forecasts that come from central banks always assume that you get back to the magic 2% inflationary number at some point. Now, you can argue whether that is due to their policy making or otherwise, but I don't know if I would characterize them as being toothless. I would certainly say that they're not necessarily as fully in control of things as they might like us to believe, but for sure, every central banker is going to be keen that they're not the ones who let inflation run away under their watch. So we think that the risk of a policy error of rates staying a little bit too high for the underlying strength of the economy is something that should be taken pretty seriously.
But the big elephant in the room, of course, is debt. Globally, we've become a very indebted world. COVID was very costly. So as the US and the UK remain shackled with debt, can Western economies grow against the backdrop of very little money?
I guess that remains to be seen, and this is where Jerry gets deeply embedded in these big picture debates. I think the question is always, are you growing at a rate stronger than the cost of your borrowing? So as long as you're growing at a rate that's above the interest cost, then that's helpful. The problem is that we've seen time and again that once debt gets to a certain level, it has a real sort of dampening effect on the level of growth that you're able to generate. I think this is where you stray into the realms of politics in terms of how you can try to stimulate the growth required and the appropriate policy mix between monetary policy, between fiscal policy, etc. But without doubt, there's a problem within the UK and Western Europe of being able to generate meaningful growth that's going to deliver improved economic outcomes for all of us. So when we're trying to think about what that means for our available universe of investment instruments for driving client returns, we've got to make sure that we've got the right mix of assets that are there that can benefit from a wide range of different outcomes. So I think it's foolish to make investment decisions that are predicated on a really strong view on these massive big picture questions. You've got to be slightly more nuanced in terms of how you think the different moving parts of your portfolio are moving. That's a really long answer of saying basically I don't know. but what we try and do is trying to control the outcomes for client portfolios, notwithstanding the result of that question.
But also it's foolish to make your investment decisions based on what you see on TikTok. But we understand that it's the TikTok influencers who could decide who is going to win the US election in 2024. I'm just wondering, to what extent will 2024 be defined by the elections in the US and the UK, and will we see a return to Trump economics, Trumponomics?
Yeah, well, it's bound to be fascinating in terms of how the electoral cycle plays through. I think it seems bizarre to a lot of outsiders how the US can be sort of stuck in this stasis between the two options that a lot of observers don't see as particularly attractive. I think throughout the course of the next 9 months, we'll probably see some of the policy choices become a little bit more clarified. At the moment, it feels like the two different sides are just sparring, and markets aren't really taking a view on the impact at the moment. I think we're still sort of caught in the trap of just sort of wondering at the personalities and how we've got to this point. I think what will be really interesting is if we see a repeated sort of set of policies if Trump does get elected. Is the reaction function from the US government still going to be the same, and are we still going to, would we see a bunch of policies overturned or reversed to sort of try and generate that strong emphasis that you provide back in 2016 from the benefits of fiscal changes. It's not necessarily clear to me that the election would have the same boost, given that what we've seen from some of the policies that Biden has put in place post-Trump as well, which have been pretty expansionary in their own right.
It'll be interesting to see what happens if the Labour Party gets in next year, particularly as Keir Starmer is such an admirer of Maggie Thatcher. But let's have a look at how all of this impacts the market landscape. I'm just wondering, will the market be influenced by a Labour government or another government? We don't know yet.
Yeah, so the UK is a really interesting case in point. It's something that we, as the majority of our clients are sterling based. We offer portfolios for US dollar and euro investors as well, but the majority are sterling based. And that as a starting point has been, a pretty wild ride over the past 7 or 8 years, in the way that people's perception of the UK has changed on international markets. So I think anything that can suggest that the UK is generating a bit more growth, obviously, but also a bit more stability, could have a real impact on the way that UK assets behave. So we characterize things at the moment specifically to the UK as thinking that there's a lot of value there, but you could have made the arguments that UK assets are cheap for a long period of time. What isn't clear is how both domestic and international investors are going to perceive that value in the future. Do they need to have some strong, visible, reliable catalyst to unearth some of that value? And that's what we're not sure of at the moment. So we've still got quite a large bias towards the mega caps within the FTSE 100 because we like some of the sectoral exposures. But it's something that we're monitoring pretty closely, and we'll be discussing it next week's investment committee. If we can extend that more broadly out to the rest of the world, I think it's even more interesting, because at the moment you've got bond investors now who are increasingly confident that this inflationary impulse has passed and that they can see monetary policy changes in the future. At the moment, you're seeing expectations for inflation receding, you're seeing expectations for interest rates reducing, but you're also there with a pretty decent employment picture, and people are still giving equity markets the benefit of the doubt that their earnings are going to be resilient amongst this backdrop. So all in all, people are definitely pricing in a soft landing. It appears to us as though that the path towards that soft landing is narrowing quite a lot. So we don't imagine that it's going to be plain sailing for both equity and fixed income in the months to come. So we're just focusing on building in as much resilience as possible into portfolios, so that we've got different asset classes that can respond in a positive way to different environments.
How often does your investment committee meet, or is this the end of year roundup, or do you meet pretty frequently and your portfolio is quite flexible and can move with trends and sectoral differences?
Yeah, so we meet on a monthly basis, but obviously the investment team are sort of communicating on an ongoing basis. Our model at Netwealth is very much to say, can we build sensible portfolios in an efficient way, mostly using passive instruments, so keeping costs and charges as low as possible, so we can return as much as that market premium back to our clients, and that served us pretty well over the past 7 years. I think it's important to get that balance right between retaining some flexibility to respond to a changing environment, but the one thing we're super aware of is the risks of overtrading and getting caught amongst the changing moods of the market and being overly responsive to what's going on. We think that's a mistake that a lot of people make. So if there's a reason where we can stick to our strategic view on different asset classes and our various investment portfolio building blocks, then we'll stick to those. And to be honest, we're pretty close to our strategic allocations at the moment.
Are they purely UK based? Because I was going to ask you finally, there isn't universal economic malaise. There are emerging and developing countries. I was wondering, who are they? What are they doing differently? Are you paying attention to them?
Yeah, we're certainly paying attention to them. I think the fascinating thing over the past 12, 13 years now has been how the price for which international investors are willing to pay for some of that emerging growth has just fallen bit by bit. So emerging markets as a a generic sort of unrealistic block have underperformed over the past 15 years by a huge amount versus, say, the US. And that's because people see that the level of economic growth, economic growth sort of narrow in the US, so they don't think that it's worth paying as much for the future growth prospects, combined with greater geopolitical risk. So the result is that coming out of the global financial crisis about 15 years ago, emerging markets were valued pretty highly. That premium has just been eroded such that they're at a distinct valuation discount to particularly the US. So we're in a weird position where people aren't backing that growth in the same way. Undoubtedly, there are going to be good growth stories, but it's a question of whether or not the market is willing to give them the benefit of the doubt, or whether it reverts back to the position where we're at the moment, whereby the market's only really paying up for companies, typically in the US, where they think that they can extrapolate future sort of strong present earnings potential way out into the future. So those big magnificent 7 names that I'm sure you've spoken about with a bunch of different investors.
Many thanks, Iain. Well, thank you very much indeed. I'm going to talk to Tom now, but if you can come back just at the end when Tom's finished his presentation, and the three of us can have a bit of a parlance about everything that we have discussed within.
Brilliant.
Thank you very much.
Speak soon. Thank you, Sarah.
You're welcome. So thank you, Iain. Next is Tom Kimche, who is Netwealth Senior Client Advisor, who's going to discuss choosing the right risk level in 2024, tax allowances, and Netwealth's bespoke tools. I understand we're going to get a demonstration. Tom, thank you.
That's right. Thank you very much, Sarah, and good afternoon to all of our attendees today. So, as Sarah said, we're going to start by talking a little bit about some of the financial planning considerations, building on what Iain and Sarah just discussed, and helping to implement some of those ideas and put you in good stead for next year when investing. So I wanted to start at the very beginning with something quite simple, which is why invest at all? And to many of you, this will be quite obvious, but actually there are sometimes quite different reasons, and particularly with interest rates now being higher than they have been in recent years, it does actually lead quite a few investors, we find, to think, why invest at all? Shall I just hold cash and wait for things to get better? So what I'm showing on screen now is just how interest rates have moved in recent years and going further back still, actually. So you can see interest rates have been pretty low for the last 20 years or so, but have risen pretty steeply, up to about 5.25% now. And on money market funds, you can earn that sort of return. So that is clearly much more attractive now than it was last year or the year before. But actually, of course, often when investing, why do you invest? It's to keep up with inflation. That's certainly in the long run when thinking about something like retirement or meeting most financial objectives, really. You do want to earn a real return, so return ahead of inflation. And with an interest rate of even 5%, certainly last year, you wouldn't have kept up with inflation if only achieving that level of return. So even when interest rates rise, often inflation is higher than that level still. And the only way you can feel pretty confident that you'll beat inflation in the long run is by investing in assets that can be expected to perform better than cash will. And this next slide demonstrates that position quite well, we think. So here we look at the comparison between a cash portfolio and we look at an invested portfolio. So the invested portfolio is the lighter blue line. And this one is the Netwealth Risk Level 4 portfolio, which is a balanced portfolio, moderate risk, and it has approximately 50% of its assets in equities or company shares and about 50% in fixed income or bonds. Both of the performance over this period have been deflated by RPI. So you see the cash return starts off positive and certainly starts off better than the invested portfolio, because we started in 2007, you may notice. So the invested position is quite unfortunate of its timing, you can say, with the benefit of hindsight, because it invested just before the financial crisis. So after about 2 years, or a year and a half, say, the person who held cash, if we're comparing the two, was quite smart because they hadn't experienced that fall in markets and they were in a much better position than the invested portfolio. But you can see in the long run, the invested position does much better, and gives you a real return, so their purchasing power has increased over the period, and the cash position, meanwhile, has lost an awful lot of its purchasing power, even factoring in higher interest rates towards the end of this period, because inflation was much higher too. You can see the invested portfolio also does badly towards the end of this period, but nonetheless, it's still a much better position overall than the cash position. So it's really in the long run that investing benefits you, and we'll come on to later strategies for getting invested if you're holding cash at the moment and you're a bit nervous about particular timing. But generally, when investing, it is to benefit from a real return in the long run. So next, I'm going to talk about some of the other challenges and some of the things we talk to investors about to help mitigate some of those challenges. And we look at things that we can control when investing and things that we can't control. So starting with those things that we can't control, but we can certainly model for, and we can certainly take them into account. They are what you can see on the left-hand side of this slide. So it's market performance, the long-term average return that, of course, any individual investor can't dictate, can't control, but you can certainly give yourself more or less exposure to that market, and you can look at your risk level carefully and make sure it's appropriate for you. Inflation's again something you can't control, but you can certainly be mindful of it and make sure your plans take it into account. And if you're thinking about retirement particularly, how long you live for is again something you can't directly control. You can of course influence it slightly, but you can certainly model for it and make sure your plans factor in maybe living slightly longer than you might anticipate. But then what can you actually do as an investor? And these are the things I'm going to focus on, and the things that we as our financial planning team certainly help clients think about and put into context. And it's the things on the right hand side of this slide. So it's things like being invested, not sitting on too much cash, and certainly not trying to call the top of the market and pull all of your money out of markets and into cash, or trying to call the bottom of the market, because as much as that would be a brilliant strategy if you could get those calls right every single time, in practice that's all but impossible. So it's about the long-term growth of the portfolio we think that's most important. And diversification, also extremely important. For a given level of risk, you can expect a higher level of return, or for a given level of return, you can expect less volatility by having a suitable level of diversification and a sensibly well-constructed portfolio. And we'll go into that in some more detail later on. Using tax wrappers and allowances is also very, very important, quite simply because it means less of your return is going to the taxman. So by using your ISA allowance, pension allowances, CGT allowances, although they've reduced, they're still very valuable, particularly between spouses. So using all of those is really going to improve the net position of your portfolio, and if it's for retirement, say, help that pot last that little bit longer. And then finally, for all of the things I've just discussed, often we find a big range in the level of fees people pay for a broadly similar service. So if you can minimize fees and pay, say, 1% per annum as a total cost rather than 2%, that means 1% of the growth you might experience in a year, or 1% of the value of your portfolio, of course, stays within your portfolio, doesn't go to your investment manager or your financial planner, and it allows the pot to grow quicker than it would otherwise. So these are the things that are well within your control as an investor, and certainly the things we focus on at Netwealth, and they really help to optimize the long-term position. So if you have decided to invest, or you have a pot of money that you're thinking about investing, how do you go about doing that? We think it's great to start by thinking about your goals, and then from there, thinking about the right level of risk for your portfolio as a starting point. So what are your goals? It's often good to categorize it as, is it for a specific need, or is it for something unknown? So if it is a specific need, that often gives you quite a specific time horizon. So it could be that it's retirement. It could be that you're 60 and you're planning for, say, the next 30 years. It could be something like repaying a mortgage in 5 years' time, or it could, of course, be something that's as of yet unknown. It could be saving for a rainy day, or saving for your children and the next generation. But either way, it's good to, before you start to invest, think about what the money is likely to be used for, because then you know how much volatility you can tolerate generally. Because if you do need this money in the very short term, then you probably don't want to subject it to the significant risk of loss, because then, of course, you might not meet your objective in the same way. But if you do know you have 30 years, then generally speaking, you can afford to take a little bit more risk and strive for slightly higher returns. So at Netwealth, we have a range of portfolios that are designed to meet different client needs. So we have some low risk portfolios that have a lower risk of loss. They tend to focus on cash and very short duration, high grade credit, high grade bonds, but they have a lower chance of potential return. And at the other end of the spectrum, we have our equity based portfolios invested primarily in globally diversified company shares, which have a higher potential return, but they do have a higher risk of loss, at least in the short term. There is an interesting discussion to be had about the actual risk if investing in the very long term, because although in any given period you could lose money if there's a recession, say, or negative sentiment in markets, actually there is a larger risk of not beating inflation by investing in the more defensive assets. But how do we actually construct these portfolios? What goes into our thinking? Iain touched on some of this earlier and mentioned how we do have an overwhelming preference of passive funds, but I thought it'd be worth talking about how we actually build these portfolios and what our starting point is and how we go about managing them on an ongoing basis. So our approach combines an active multi-asset allocation with primarily passive implementation. But there is some nuance to that. So strategic asset allocation are the starting point. And there's an active element to it because we, of course, consciously choose those positions and we appraise them every 12 months. But it's certainly passive in that we design these positions for the long term and we don't intend to make meaningful changes regularly to them. The next part is our instrument selection. So this is us choosing the building blocks that we use to construct the portfolios. So it's looking first of all at, do we want to use passive funds? Do we want to use directly held shares? Do we want to use actively managed funds? As I mentioned, we do have a preference for these passive funds, but we still have to look at which passive fund we want to invest in. There's a wide variety of exposures they have. There's different levels of liquidity, different levels of costs, different ways of tracking an index, say. So that's all goes into the process. And then the final part is our cyclical positions. Sometimes these are referred to as tactical positions. And these are our shorter term decisions that take into account relative valuation, say, or macroeconomic or policy data. And these can happen at any time, depending on what's happening in markets. But using passive funds does help keep costs down overall. But we largely do that because we think that'll lead to better outcomes for portfolios. Moving on to diversification specifically, why is that so important? So this is a slide we often use to give clients some context here, and it shows a range of different asset classes in lots of different calendar years, going from 2007 to 2022. So each of the columns is ranked from the top performer to the worst performer. So for example, in 2007, EM equities, emerging market equities, were the best performer, and REITs, or real estate investment trusts, were the worst performer. I won't, of course, go through each column here in detail, but what you'll hopefully notice is there isn't much of a pattern to be found within this. It's a bit of a quilt of different investment returns. What you may notice, however, is that the portfolio, so that's the white box that just says portfolio in the middle, that tends to be around the middle or towards the higher ends of these columns. So that's a diversified portfolio that has a complementary mix of some of these underlying assets designed to smooth the path of returns throughout the years. And we think that often leads to better outcomes for an investor that wants to get a real return ahead of inflation, but also doesn't want to subject themselves to too much risk. Because, of course, as I alluded to a little bit earlier, it would be great if you knew in advance which asset would be the top performer each year, but that is all but impossible in practice. The other thing you may notice here that's a little bit difficult to tell is that cash will very rarely be the top performer. Sometimes in years when market sentiment is very, very bad, cash will do better, but generally speaking, you won't expect to beat inflation by holding cash. Bonds is an interesting topic, and it's something we're often asked about. Why do you hold bonds? Bonds, particularly in the recent years, haven't been yielding very much, and of course last year was very negative for bonds overall in terms of them not quite doing what clients often hold them for. But if you look at the wider period, we can see that fixed income tends to give positive returns when equities are doing badly. So what we show here in the navy blue is the biggest intra-year drawdown. So within a calendar year, what was the biggest loss you had experienced on equities? And then we show in the grey bar in the same year how fixed income or bonds performed during that period. So 2008 gives you the starkest difference there. Equities was down about 40%, and during that same period, the fixed income side of things was up nearly 10%. So if you had just held equities, you'd have lost 40%. If you'd have just held fixed income, you'd have made a profit. But if you held a blend, the fixed income would have offset some of your losses. Now, if you have a very, very long time horizon, you might not be worried about some of these negative years because you're looking at the longer term potential for higher returns. So you might just want to hold predominantly equities. But if you don't want to subject yourself to quite this level of drawdown, these fixed income assets can often offset these losses. And you can see in almost every year here, you saw a positive period for bonds when equities fell the most. And that's largely why we hold them. It's a bit of a simplification, but hopefully it gives you the idea. There's no escaping it. 2022 was a major outlier because equities were down, bonds were also down. So during 2022, that relationship didn't hold up quite so well, particularly unique with inflation persisting at higher levels than anyone quite anticipated, and central banks having to therefore raise interest rates more than they planned to and more than the market expected. But that certainly doesn't change our view on why holding bonds is useful generally. And actually, with the yields you can currently receive on bonds, we certainly think there's lots of merit in holding them still. The next thing I want to do is provide the demonstration that Sarah alluded to. So I'm just going to switch screen now and show you how you might do some planning yourself using our online tools. So I'm just switching to the web browser, and this is on our website at netwealth.com. By the way, you might want to actually log in now. You wouldn't spend 30 seconds just registering, but it's completely free and doesn't take very long at all. But here you can input some of your data on your pensions, on your ISAs, on your general accounts. You can put in some information on your planning and actually see how your plan looks and see whether it's sustainable and see whether you're able to meet your objectives. So I'll quickly run you through what we're looking at on the screen at the moment. So this is somebody that has 1.2 million of wealth across their pensions, ISA and general accounts. They are 49, they earn £200,000, they want to retire when they're 60, and they want to spend £5,000 a month. And they also want to pay off their mortgage using £125,000. So this information has all been input already by me, just to give you an idea. But you can, of course, put in your own personal information and get a projection that makes sense to you. So this person has a pension. I've actually have various pensions, and you can see the risk level this is modelled at. So you can also go back in here, change the risk level, and see what difference that makes to your plan. This person also has defined benefit pension, a defined benefit pension. You can put in your state pension. You can put in the lifetime allowance, not quite so relevant nowadays, of course, but nonetheless, if that does change, then that will be updated. Investments such as ISAs are also included. You can choose a risk level for them. You can choose multiple risk levels if that's how you prefer to look at things. And then you can see how likely you are to meet your objective. So the summary in this case, as it pans out, is that the client can actually meet their objective. So they are on track, as it confirms down here on the left-hand side. But what they might want to do is say, actually, what happens if I want to spend, say, £7,000 a month rather than £5,000? So if we type in £7,000, confirm the changes, go back to the projection, and then rerun it, we will be able to see what that looks like. And it's a really useful tool in general, just for putting things into context, because it's great to have an idea of what your plans are or what your best intentions are. But if it's actually not going to work for you, then it's good to make those changes in advance rather than wait far into your retirement, say, before realizing this isn't quite going to work for you. So in this case, £7,000 as a target monthly income might be a little bit ambitious, but this does actually model to age 95. So the client might actually take a view that actually lasting until about age 93 is actually okay for them, and they're happy to invest on this basis. So as I mentioned, this tool is available at netwealth.com. If I log out, I will show you what that looks like. So this is just my Netwealth here to begin with, but if you come to netwealth.com and you click Start Now here, you'll be able to sign up to that, and it's all completely free to use, and it's a great idea to just get an idea of how your plans are progressing. And so certainly feel free to check that out if you have some time. Moving back to the main presentation, I'm going to now focus on some strategies for actually getting invested, particularly for those that are holding cash at the moment, and they're not quite sure what to do with it, and they're not quite sure if now is the right time. So, I did touch upon this earlier, but it's really worth reiterating that we think it's so important to focus on time in the markets rather than timing the market, trying to call the tops and the bottoms. So this chart looks at the S&P 500 going all the way back to 1987 to the end of 2022, the S&P 500 being the 500 largest companies in the US, in America. So you can see over this total period, the returns in dollars have been 3,371%, so very strong. But if you had missed just the top 10 days, the return would have fallen from 3,371% to 1,450%. So a very significant drop just by missing the 10 best days. Now, you might argue that that's slightly cherry-picked, and you could say, okay, if you missed the 10 worst days, you would be in a much better position, which is true as well. But the point is, it's very, very difficult to call these days in advance. What you do know is by being invested throughout the whole period, you've got an extremely strong return. And that's the sort of thing we'd expect going forwards, particularly with those long time horizons. But if you're holding cash at the moment, one other thing you consider is staggering this cash into markets over time. So this isn't something that we tend to recommend to clients at Netwealth by default, but it's certainly worth bearing in mind. And if markets fall, it can protect you. So here we look at, again, the Netwealth Risk Level 4 portfolio, a balanced portfolio, and we compare a strategy where the money was fully invested all on day one versus a strategy where it was staggered over 5 months versus a strategy where it's staggered over 10 months. And we can see here, after the initial period, if you had been fully invested by March 2009, your £250,000 would have fallen to £197,000, or nearly £198,000. If you had staggered this money into markets over 10 months, you'd have actually protected some value there, because the portfolio would have been worth £212,000 by March 2009. So in that scenario, with markets falling, as you stagger into markets, you are protected. So if you're either just quite nervous about investing and you don't think you could quite stomach a big market fall soon after investing, and it might tempt you to sell and crystallize that loss entirely, this is certainly something worth considering, and certainly at Netwealth it's extremely easy to facilitate in various ways. But it is worth mentioning that actually you can miss out on some potential upside as well by doing this. So here we look at a sort of alternative scenario, which is the opposite. Again, investing £250,000, somebody staggering over 5 months, somebody staggering over 10 months. And in this period, when we look at July 2016, the person that was fully invested, they do better because markets rose quite soon after they invested, and they had £264,000 compared to the person who left money in cash and only staggered in over 10 months, only having £252,000 by July 2016. So you certainly don't guarantee yourself better performance by staggering in over time, but you can lessen the chances of a big loss, which is certainly beneficial to some clients. The final thing I wanted to talk about was just the difference fees can make. And again, it's something I touched on earlier, but always worth reiterating. And it's just the difference, certainly over time, that a relatively small headline change in fees can make. So here we just compare our fee level versus the sort of fee level you might see from a traditional wealth manager. We look at £500,000 invested at the start. We look at growth over 20 years. And in both cases, you're looking at a gross annual return of 5%. But just due to the fee difference, you can see quite a large difference develops in the total client portfolio value over time. So you can see after only 10 years, there's a £70,000 difference. So the lower fee at Netwealth results in £773,000 versus £702,000 in the higher fee portfolio. And by the end, there's nearly £200,000 difference in the asset value. It's pretty significant, considering the only difference here is the level of fees. The return's the same, the diversification's the same, the client's drawdown strategy may well be the same. But just by paying 1% less in fees, you've got £200,000 less in the portfolio. And it was only a starting portfolio value of £500,000. So yeah, by saving in fees, you can actually see much better outcomes, certainly in the long run. So in summary, we think for 2024 particularly, it's really important to be aware of the key challenges, so market performance, inflation, and if thinking about retirement, how long you live. Controlling the controllables can make a really big difference, and particularly lower fees can help you generate better net returns. Carefully considering your goals and the level of risk you want to take on will really help get you started when investing, and sensible financial planning and maybe using our tools will help you manage your wealth and hopefully meet your objectives. I'm going to pass back to Sarah now, who is going to host a Q&A, I believe.
Yep, thank you. Thanks, Tom. We'll invite Iain back in as well. So just to summarise, don't ignore the stock market. Make sure you're well diversified. Don't overpay in fees, very important, music to my ears. Use tax wrappers effectively. And I think what tickled me is plan for living longer than expected, because the free tools that Netwealth has goes up to the age of 95. Perhaps you should push it higher for those who intend to reach 3 figures.
Yeah, it's an interesting one. With the online tools, we have to sort of draw a middle ground between making it accessible, making it useful. But yeah, certainly for those that do want to look beyond age 95, I think that the starting point for that would be just to sort of extrapolate the chart you can look at. But certainly, if clients are interested in that, then we certainly have bespoke models behind the scenes that we can talk clients through and help them see how likely that is and see what that means for their financial plans.
Yeah, but we do love free tools. What we haven't really explored, though, is about optimizing the withdrawal strategy, because, amassing a reasonable pot is one thing, but how you access the funds that you've accrued is crucial. We've all talked about timing, but, when is the right time to withdraw, and in what increments?
Yeah, I mean, this is a question that really does depend on the person, because of course you should ideally withdraw when you need the money, first of all. But then in terms of the account types, it depends what you have. So if you have a pension, say an ISA and a general investment account, then you need to consider, particularly for the pension, how much income tax you're paying, because yes, you can take 25% of it tax-free in most cases, but you don't necessarily need to take that all in one go. Money you take from the pension comes into your estate for inheritance tax purposes. So if you are pretty sure you're going to spend it, that might not be a problem because it won't sit in your estate for a long time. But if you're not, then it might just sit there and you might choose to invest it elsewhere. But then if you've used your ISA allowance, you might start to pay income tax on dividends and capital gains tax on the growth you receive. So that all needs to be carefully considered. Generally, with taking money from a pension, we look to aim to essentially minimize the level of tax you pay on a blended basis across your retirement. Because if you take, say, lots and lots of pension income in 1 year, that might push you into the higher rate tax bands. And that could have been avoided, say, if you took out less income gradually over a number of years. So it does depend a little bit. Often we see, for example, clients receiving a state pension a few years later into their retirement. And in that case, they might want to stop taking some pension income then, because that state pension is using up most of their tax-free personal allowance, for example. So unfortunately, there certainly isn't a one-size-fits-all drawdown strategy. But often we see, particularly for affluent clients with around, say, $1 million in their pension, it can be sensible to try and use your basic rate income tax band. But it really does depend.
Okay, so Tom and Iain, you've shared all this intelligence very generously. But Iain, I'm thinking about anecdotes, what Netwealth customers talking about, what their main concerns are, because right at the beginning of our conversation, at the beginning of this session, you said that it had been an interesting year. I thought that was a euphemism. So over this year, what is the recurring commentary that you are getting from your customers?
Gosh, well, I think the to me the most interesting thing about this year is that the sentiment around everything, like it's been clearly a very hard year for a lot of different people in a wide range of different circumstances, with cost of living going up so much strongly. What we found ourselves as we were reviewing portfolio performance this morning, actually, on our team call, was that if you hadn't paid attention to any of the news, you're sitting there for our sterling investors with returns ranging from 3 to 7% over the course of the year. For our US dollar oriented investors, that's substantially higher, because the market has been somewhat different. So there's this massive dispersion between really what has happened to people's investment portfolios and the way that people are feeling about the way that their money is working at the moment. Now, of course, people are attracted to attractive cash rates at the moment, but what we're trying to encourage people to think about, and bear in mind, we've got investment portfolios that go across the whole spectrum, from very cash-like assets across to more growth-oriented strategies, is just to make sure that you know that if you're looking at cash returns at the moment, say 5%, you've got to be aware of what you might be missing out on as investment markets start to respond to this peak, if you like, in interest rates, because investment markets will respond extremely quickly, and they have done over the past month, to the perception of a better environment in the future. And so people who are in cash, there's a lot of reassurance for that, and your personal circumstances will certainly drive whether or not that's right for you. But you need to be aware that it's not just an easy, definite win by sitting in that position.
So let's have a look at what the investment themes this week, the first week of the last month of the year. And there's this big debate between physical gold and digital gold. So we've seen gold and Bitcoin have a really good rally. I'm wondering, is there any correlation between the two, or because some people are now saying, well, actually, Bitcoin is a longer term store of value, and it perhaps should now be seen as the safe haven. So I'm wondering if you're going to be discussing that in your investment committee meeting next week.
Well, yeah, so it's an interesting question. Like from our point of view, we run 7 risk profiles, going from 1, most cautious, up to 7, the most ambitious. I think if we were including an asset as volatile as Bitcoin, we'd need to be looking at risk levels like 8, 9, 10, 11, 12, up to 20. It's not within our spectrum of things that we typically look at, but I think it is very interesting as a gauge of where investor risk appetite is. And what you've seen over the past month is that, yeah, gold has gone up, bonds have gone up, equities have done okay in some circumstances. The only thing that's gone down is the expectation of future interest rates, which is the sort of trigger for everything, and energy costs. So commodities as a whole. I think it's super interesting. We sort of encourage clients, if that's something that they're keen on following, either as a hobby or as a true investment thesis, then they're best advised to do that outside of our structure. It's not something that we do.
Yeah, but it's certainly worth a conversation at the water cooler, as it were. So Tom, 2024, again, you're very client facing. You've showed us that fabulous graph as to what were the top investments by each year. Gold did feature in 3 or 4 of those columns, but 2024, I'm not asking you to look into your crystal ball, but 2024, you're obviously preparing for this. I mean, in fact, you never switch off. But what do you think will be the investment themes of the next 12 months?
Yeah, it's very, very difficult to say in advance, because if we look at what has happened or what's been most interesting to investors, certainly what's kept us busy with phone calls, what's intrigued clients, should we say, over the last few years, it's been things that were just completely impossible to predict, really. Things like the pandemic, things like wars, sadly. So if that's the sort of thing that could come around and could dominate headlines, it could concern clients, but we just can't really say in advance. But I think moving into 2024, the things that are on the horizon, the things that we are aware of, will be some of the things I think that Iain did touch on briefly earlier. Things like what happens with interest rates. Does the central bank still have credibility? Do people believe that they won't lower them? But that will, of course, depend on what happens with economic growth and what happens with unemployment, what happens with companies' profitability. So they will stay in the headlines, and I think they will be the biggest concerns outside of any big shocks. Things like Bitcoin, things like gold, that's unlikely to go away in the short term. But I think we'll see a continuing trend of things like China. What happens there? Do they sort of get back on track after a difficult last year or two? So they're probably the main headlines. But I think the things that are likely to be most important at the end of 2024 will be things that we just didn't see on the horizon at all, as is often the case. Not sure if I've missed anything there, Iain, or is there anything you'd add?
Well, I'm not seeing any questions from the audience, so I'm just wondering whether 2023 is actually shell-shocked all of Iain, were you going to say something about?
Well, I was just going to say that I think the point that Tom made earlier about being able to control the controllables is the most emphatic one. So where we've got structures in place, which, you know, keeping a laser-like focus on costs, making sure that you understand the way that different asset classes interact. You might not be able to predict specific events, but you can certainly build a range of outcomes based on what you know about the different asset classes that you're familiar with. For me, the biggest picture, like Tom said, is what happens to interest rates. We don't know if this sort of benign disinflationary environment is going to keep progressing at the pace that people currently expect, but the reaction function of different central banks and policymakers to this, you know, this moving picture is going to be very interesting to watch. So that's what we're looking at.
And it's a lovely way to end this webinar. Thank you, Iain. Thank you, Tom. Thank you to Jerry, who'd prepared for this webinar, but the power cut got the better of him. Thank you to Netwealth, Joe Jeffrey, and Master Investors, Tim Corcoran and Amanda Taylor, and you, the audience. And for more information about those tools that Tom referenced, they are free. Go to netwealth.com. You can also get a big bank of equally gorgeous content from masterinvestor.co.uk. Thank you. We will see you next year, which you are now very prepared for, courtesy of Tom and Iain. And from all of us at Netwealth and Master Investor, a very Merry Christmas to you. Cheerio. Thank you.
Thank you.